Hello, welcome back. Episode 89.
Mm.
We are just chugging along.
Chugging along.
Yep.
New year.
New year, new us a little bit
It is?
to jump into that
Oh.
vibe. I mean,
Oh, okay.
the year,
I'm like, wow.
not us personally, but at Gradient Investments, a lot of new things
Oh,
happen.
for
right?
sure.
So
yes.
we are coming out swinging this year.
We are.
Mhm.
A lot
So
of good stuff.
we get to that in a little bit, what recent developments there are. But first of all, let's start off with truth and a lie. So our listeners have something to think about a little bit, as we always do. And I thought we do like an episode of current market headlines today, or something that recently happened. So buckle up.
So if you didn't read the news yesterday, you're in trouble.
Boy.
Yeah, news or market performance or
Mhm,
whatever.
mhm.
So you're about to get busted, Kyle. It seems someone is afraid here. So let's start. Netflix dropped about 15% since the deal with Warner was announced. That is still not done, by the way, and dropped about 5% after market yesterday after it reported its earnings. Yesterday. So that is Tuesday the 20th. In that case, for our listeners that do not know what yesterday and today is. So yesterday, Tuesday, 20th January, the Nasdaq posted a loss of 2%, marking the worst day since April 2025, the first daily performance. Or C, gold reached a new all-time high yesterday at $4,750 per ounce, amid renewed and continued geopolitical uncertainties. Let's start with Kyle. He looks a little bit afraid.
I'm
scared.
super afraid.
A lot of numbers in there.
A lot of numbers.
There's way too many numbers.
Just for Kyle.
Ooh.
So what's your best shot here?
I don't know. Gold reaching all-time high. I don't know. That doesn't seem like it was in the... I didn't see that flash by the screen yesterday, but maybe I wasn't looking. So
You're not looking at gold?
I don't look at gold every day. That's like one thing I don't really look at. I notice it in the periphery.
Lisa's got one. She got four screens and she's got one dedicated.
It's just gold.
It's just
all
gold.
four screens are gold. Yeah. Nasdaq. I mean, the market was down 2%, so I could see that. I think she meddled with A. I feel like the merger arb guys are out there like down 15%. That seems like out of whack. Now I did see Netflix after they reported and they were down, I think it was like 4.7 or something. So maybe
5
she's
is close enough.
Close enough. I think is a rounding. So I'm going to go with A because I think it's the 15% is the squirrely little Y.
He's even dialing in.
Mm-hmm.
Keith, what's your best shot?
I don't know. I'm going to disagree with Kyle. I say A is correct. It's been a pretty poor performer since the potential announced deal, and it was down.
Which is kind of a mess in itself.
Mm-hmm.
It's been a mess in itself, and the 5% was after hours. I think this morning was actually down a titch even worse than that.
Oh, yeah, was it?
Yeah.
That is, yesterday.
I got you. So I'm saying that's true. Gold. Lisa can't lie about her gold, so it's got to be true. It's all-time high. I know it did hit an all-time high. I think it was 47.50-ish.
Every day it does.
Because people are talking 5,000 now for the next kind of hurdle, so it's close. So that's true. That leaves B as false because my guess is the Nasdaq posted a 2% loss, which I think is true, but I think it's been a different time frame since April of 2025. So I'm going with B.
Very well reasoned, both of you.
And
Keith is right.
Nice.
I tempered with B. So Netflix actually is down around about 15%. That is correct.
That's a big number. Bigger than I would have thought.
I own it, so I know.
Oh, I don't.
Gold is correct. Reached a new all-time high yesterday. And the Nasdaq posted a 2% loss. That is correct, but it was not the worst day since April. You're right, Keith. It was the worst day since October 2025.
Wow.
So, yeah.
Tricky.
It was tricky.
Yeah, I have to opt up my game a little bit.
Wow.
You're too good for this. So anyways, like we teased in the beginning, like the year is young, but at GI, a lot of amazing things are already happening.
There are.
Because, yeah, we launched a couple new products, and not just any products, some very specific ones. And we launched, first start off with the new private wealth series, which is alternatives. And Kyle is our alternatives guru here. So
He is the guru there.
yeah, he worked hard and tireless the last couple of months to.
That's why he wasn't paying attention to the market. you know?
Exactly,
right.
because he worked so hard on
My
our,
screen for gold is missing. Now it's all alts.
It's just alt. Right. So Kyle, you're our alternatives guru here, and we launched the private wealth series, which is dedicated alternatives. Which we are actually one of the first ones in the whole US.
Yep.
Wow. How about the clap there?
Where's the clap? So really good.
Good thing she didn't hit the crickets one.
Yeah, right. That's always, a little
A little iffy.
a little iffy what button I reach here. Anyways, we are one of the first ones in the US who launched it in a separately managed account
Right.
strategy. But Kyle, let's start off a little bit, and I want to start off with you because you initiated all of that, and you're really the OG person in this space. What do we mean actually by when we talk about alternatives, right? Because some people say, there's different versions out there. What is called alternatives or not? You can
Right.
say Bitcoin is alternatives, gold even is alternatives, infrastructure, and all of that. But we mean something different than those alternatives
Right.
with that. So
Right.
can you explain a little bit what we mean by that?
Yeah. So alternatives are definitely a broad basket. It's people will say alts and they might mean many different things. So traditionally alternatives would be private market assets. So it would be private equity, private credit, private infrastructure, private real estate. Now, a lot of those asset classes in the public sphere exist. You can go and buy utility operators, that are doing ports and logistics and, water infrastructure, data warehouses, that kind of thing. But the corollary to the public markets means that you have, that strong public market exposure, and it goes more or less in line with public markets, the S&P 500, being kind of the proxy for it. So alternatives, what we're talking about would be the tried and true, truly private, investments. And those were traditionally just institutional investors, high net worth, ultra high net worth clients, where you had to have, several $1 million, $5 to $10 million of capital that you committed and would be called upon and drawn down into those private investments over a course of 7 to 10 years. So very different.
Yeah.
They're not very. Nice thing about public markets, they're priced daily, right? So now with alternatives, are they obviously not? Daily price discovery is not quite there.
Right.
Or talk about that a little bit.
Yeah. So you kind of think, the best analogy I would say would be, if you're buying a home, you walking through the neighborhood and you say, hey, this is the house. And let's say the sticker price is, $500,000. And you look at it and say, okay, this is great. I actually think maybe it's $480,000. I'm gonna sandbag him a little bit on the number because this, or this. So you make the offer, they might counter back and say, we'll split the difference. We'll go $490,000. That kind of murky, opaque price discovery is basically how it works in private markets. Is no different. It's a house is a private asset. And then as soon as you make that sale, that crystallizes the price. So now it is transparent. We can see it. And so if you go, partly how that price is discovered in that context would be, you look for other houses sold in the neighborhood recently, right? Same kind of square footage, same kind of neighborhood, that kind of thing. So that allows you kind of an ability to see around approximately what it's going to be. And private assets are the same kind of thing. So complex business valuation is needed to understand what the, valuations are. And in many cases, it's not a guess, it's an educated guess. So until they exit or actually sell, just like a house, you might live in that house for 10 years and markets appreciate, the neighborhood appreciates, and let's say it's 700, you think, you won't know until it again sells.
Right? No, that's a good analogy. I think that people should be able to understand. It's definitely goes up over time, and it's it's price discovery beginning and end.
And I mean, they work like completely different than public markets, right? And it's kind of for the normal investor, it's something new still, because a lot has changed in this space, right? I mean, you said it already. Before that, it was only for really high-end investors, basically very wealthy investors. We know alternatives mainly from endowment funds, from pension funds, from family offices. They always had kind of quite a good exposure to that space. But like the private investor, not really, because there was just not really a vehicle available to them.
Right.
So, Keith, why did we introduce it now? Like, what are we seeing in this space that we think this can be like a great opportunity to introduce that right now and to bring that to our advisors and clients?
Yeah, this is just another space that we want to explore, because like Kyle mentioned, it's not as correlated to the stock market's long-term asset growth and over time, they've traditionally done quite a bit better than the public stock market. I mean, there's stats out there that show you private equity, over the last several decades is up about 14-15% annualized per year, whereas you look at the S&P, you're talking 9-10, depending on the time period you're looking for both of them. So those are just generally and the other thing is they have less standard deviation, right? With the stock market, we can see the moves like we've seen, whether it's COVID or April 2nd, Liberation Day, the aggressive sell-off. Now, if you own a private asset, you weren't marking down your assets down 20, like in the recent tariff announcements, stock market was down almost 20%. Fundamental assets haven't really changed. It's what valuation people were putting on them. They're getting nervous. Whereas if you own these private assets, they didn't get marked down 20%, and they're still fundamentally sound. And so they have less standard deviation, which means less volatility, which generally speaking, investors like less volatility. So now, like, Kyle was exploring this. We're one of the first people in the country to do something like this with partnering with Case, right, Kyle?
Yep.
So I think that allows our investor base, as, clients move up, have a little more net worth. This is just another option for them to invest in. So I think it's a fantastic thing.
And also the question here, and we said, okay, it was only available for the big boys, basically the big endowments, like very wealthy investors before. Now we have a little bit more wiggle room here for normal investors, basically like you and me, who can invest in these vehicles now, because there's a lot of innovation happening in this space, and we are one of these innovators who bring that to the market, to our advisors and clients. But despite that being now more open to investors, to private investors, and more approachable and available, does that mean that is something for every investor? Or how do we seeing it? Where could it be a fit for what investor and for what investor?
Yeah, I mean, obviously, generally, you're tying up your money for a little longer time period. We always say, 5+ years for this kind of investment kind of horizon. So, which is different than some of other, portfolios we have. We have stable value, which is more like your money market's very accessible. You can get your money out easily. We have ETF-based portfolios, again, very easy to, move money around. We have stock portfolios, generally speaking, same thing. So this one is when you invest our structured notes, which has been very successful. I would akin this to that kind of, but even a little bit longer tail. Those are generally 18 months to 2-3 years, kind of how you want to kind of put your money in. You kind of know your beginning point. Generally at the end, we're market to market. There's a lot of wiggle room in between, kind of what Kyle's referring to on the private assets. So I think this is going to be a little longer tail for investment people. But again, if you can get superior returns, a little less volatility, I think it's worth, a segment of our clients and advisors looking at. And it won't be a fit for everyone, right? Not everyone has that flexibility to tie up money for multi-years.
And Kyle, maybe a question for the alternatives guru again. I want to talk a little bit more about, and we just mentioned it here and there, more about the advantages potential benefits from investing in alternatives versus potential risks and disadvantages, because they're very specific. It's very different from public market. So the benefits and risks, like risk and reward, is also different from public market. So can you talk a little bit more about that, what that means, and what it looks different than public markets?
Yeah, I mean, so a couple of the key advantages really comes down to, as Keith noted, diversification, right? So the non-correlated asset relative to the market in general. So when you're diversifying a portfolio and you're investing for the long term, you're going to want some things that are working and some things that are not, because this year the things that are working are great, but next year they might not be. A great example in public markets was international last year, right? It hadn't worked in 15 years relative to the US markets, and then it came out of nowhere. And if you were underexposed, then that was an issue. Same with gold last year, right? And silver, we saw precious metals just dominating in the last year relative to the last 20. So having exposure there to some less correlated assets really makes a big difference in terms of what your overall portfolio kind of risk and reward look like. And then I think the other thing would be just access to the illiquidity premium. So effectively for patient capital, you're paid to wait. So because they are a little less liquid, that it's kind of like a double-edged blade. Like some people don't like that because it's less liquid, it's harder to get. That's true, but you're actually being compensated extra for that, for that period. So a lot of people are familiar with like CDs. That used to be a big thing in the 90s and 2000s, where interest rates were much higher. People would say, but I'll do a 6-month CD for 6-7%, whatever it is. And same concept, you're being paid to wait. If you crack the CD open after a year or whatever, or if it's a 2-year CD, you're penalized for it. It's the same kind of concept. So and then I think the last part would be access to private companies. So the assets that we're investing in here, depending on which strategy you go with, we have 2 flavors: a growth and an income. You have really great companies that you wouldn't have access to in public markets. People think of like OpenAI or Anduril, the defense tech company that is, making some really cool stuff, or New Era baseball caps, right? Like, or like Amazon, is a publicly traded company, but their logistics warehouses where they actually store most of the goods that come to your home, they don't own those. Those are privately owned. And so, or data warehouses, like that's a big thing with AI now. So most of the time it's private companies that own the actual infrastructure that these public companies operate through, and they cash flow well, and usually people want a piece of it, whether that be a SpaceX or an OpenAI or companies like that. So I mean, you've seen the data. More and more companies are going private or staying private in the public markets. I think the 1990, I think it was 8,000 public companies, and now it's 4. It's cut in half. So having an access point with something like the private wealth series here is really, I think, revolutionary.
Especially to those names you just mentioned, like Anduril and New Era. We get questions about how do we invest in something like this? It's like, okay, well, you can't directly do it,
right?
We can find, if one of the alternatives we select has an investment there, we can get you some exposure there.
Yeah. And you already teased it. We have 2 flavors in this. One is called the Horizon, and one is called the Income Edge. Can you talk a little bit what the differences are for what investor, how to choose what to take, and maybe what is in it?
Yeah. So the Horizon strategy is mainly comprised of private equity, buyout, venture capital, some more risk on growth oriented assets in terms of what the underlying is. So that's going to be, again, that 5 to 7 to 10 plus year patient capital investment. You are taking more risk, and Keith outlined the kind of performance metrics appropriately. We've got a great little image in one of our decks that advisors and clients can see. And it shows over the last 30 years, buyout private equity has returned, like what Keith noted earlier, about 15% since 1994 through 2024, with about a third less risk standard deviation than the S&P 500. So, S&P is up 10, private equity is up 15, so it doesn't guarantee you a great outcome, but that patient capital, that access to private markets, the diversification and less correlated benefits are really, they shine over time. So that would be that one. The income edge is the as the name suggests, the income oriented strategy. That one, there's 5 vehicles in it. So it's kind of a blend of private credit. So really high end senior secured, blue chip names that we have in there. So you think about like an Apollo, which most people have heard of. If they don't know what they do, they've heard it on the news somewhere. Ares, Carlyle. So we go up and down the credit spectrum to try and generate yield for people, and we want a good mix on our plate of, the meat and potatoes. Those would be the high quality blue chip names, and then we sprinkle on some of the cayenne pepper to give it a little boost. So we want to balance risk and reward for people. And that one, private credit, we didn't mention this in the performance numbers, but likewise, when you think about performance of the private credit sphere across the entire band of quality, over the last 25 years, it's annualized about 9.5% per year. So about as good, a tick better than the S&P 500 over that period of time, with much less than 50% of the volatility, like for like. So that is compelling for people and generates income. Right now, that strategy is north of 9% in terms of distribution for people. So, if you are in need of income, that one would be a great option for people. It does pay quarterly distributions and people like that. The thing we haven't talked about, I guess, in terms of an advantage as well, relative to some of the kind of the other vehicles that existed in the past, most of the tax structure on the kind of onerous capital call strategies were K1, K3, which is this kind of archaic.
It's
a nightmare. It's
for tax people, like, you go running when you hear K1.
Right. It's like this clunky thing that doesn't come until after tax season, and then you have to pay an accountant to do extra, and it's a nightmare. So people don't like them typically. And so the new structures that we use for both of these strategies are streamlined 1099. So if there is, income, if there's, something, a distribution comes through, it's there for tax time. It's very easy, convenient, just slots in with everything else.
Is there any, you talked about the two different ones as a growth and an income. Is there, obviously, we started the conversation saying these are generally for ultra high net worth historically, and then high net worth, and then we're moving down a little bit. What kind of account minimums are kind of for these two portfolios?
Yeah, it's a good question. So for the Horizon strategy, because the private equity sleeve, the SEC requires a qualified client status, which is basically a fancy word for still a little bit more, 1.1 million net worth for people to get in for the private equity. It's more sophisticated strategy, so it's a little bit more sophisticated client still. But the minimum is $250,000 for that one to get in. And then the income edge strategy is non-accredited. So it's really, that is a strategy that I designed to really be a good fit for anybody who is looking for income. So there is no minimum net worth. It's non-accredited status, and it's $100,000 to get into that one.
So in the old days, those probably been like multi-million dollars, right?
Right.
Instead of a $250,000. Yeah, a commitment. Yeah, capital calls.
Yeah. Great. Keith, I want to kind of, because we mentioned it in the beginning, the difference in alternatives, right? That gold and Bitcoin are generally speaking also alternatives, but just like a little different flavor for it, or it's kind of a gray zone. What is called an alternative and what falls
commodity
in
or not?
Right in the greater description here. So I want to talk a little bit about what other GI portfolios, gradient investment portfolios, offers exposure to alternatives. and how that is different from the new specific alternative sleeve.
Yeah, obviously you run one of the precious metals portfolios, right? So we're not actually storing gold bars in Lisa's basement or anything like that. We're using
that we know of
anyway. Here's her address. No, but
Fort Knox here.
Yeah. So we use ETFs, and the ETFs that we're using are tied to companies that they're doing the storing of the gold. So that's an ETF base, relatively liquid. So that's the difference between what Kyle's talking about. We're having it with the private alternative that you're doing the direct investment into that company, whereas we're buying ETFs, which that's ease of use, liquidity, tax consequences generally are positive with ETFs, and it allows you to get into it. There's sometimes some ETFs don't necessarily replicate exactly like the underlying asset. That's one difference on the potential negative. But for the most part, the precious metal portfolio, we have an endowment series which is ETF based, and in that portfolio we have anywhere from 5 to 20% allocated to different alternatives, ETFs based, not this private stuff that Kyle was just talking about. And some of those could be your precious metals. They could be a variety of things that are basically you're looking for non-correlated assets, just the traditional stock and bond investor. So those are some of the stuff that we find into our endowment series.
Definitely. But as you said, different from the private wealth series here. And some investors kind of might have the question, how does that fit, right? Because investors are typically used to the 60-40, right? The typical traditional allocation. Maybe sprinkle in some precious metals.
60% stocks, 40% bonds,
right,
what the 60-40 is. Right?
The typical balanced investor. Maybe sprinkle in some gold, some precious metals as an alternative, basically. But that's about it, right? Now we have these new possibilities. And a question might come up, okay, how does this even fit into a portfolio now with all these new possibilities? So how does it fit into a portfolio?
Yeah, that's the the right question. So if you take a page out of the, famous endowments, foundations that have been around for hundreds of years, you look at the Yale, you look at Harvard. I mean, that's literally why we created the endowment series, is to try and replicate that. At the time that those were created, these new kind of evergreen perpetual structures that allow easier access to private markets, they didn't exist. I mean, these are relatively like hot off the press. They're new in the last year in terms of, wider availability. So taking a page out of those, we're not suggesting people go, to try and replicate the endowments on their own. If you look at Harvard and Yale, I think it's almost 2/3 of their assets are in alternatives, and that works for them because they're perpetual. They will live forever, right? So it's many, many lifetimes worth, and that makes sense because, again, this is patient capital for these private markets, and that works really, really great for them. I think U.S. family offices are more in line. Again, U.S. family offices, either single or multifamily, those are going to be high net worth, ultra high net worth clients. They're going to be putting between 20 to 35% of their allocations into these private markets. Pensions, same kind of thing. So where does that leave kind of the
mom and pop,
the average American? What does that look like for a portfolio? It's probably 10 to 15, 10 to 20% on the high end, depending on the kind of the appetite, the time horizon, the goals that they're looking to achieve.
Yeah, I heard someone on TV talking yesterday too, talking about that 60-40 now. They think it's 60-30-10, with that 10 being alternatives. And again, that 10 could be 15 or 20, depending on or it could be a little bit lower, depending on each person's a little bit unique. But that general 60-40 model, it's kind of a little bit under pressure. If you remember a couple of years ago, which is kind of funny, everybody thought it was going away, right? So it doesn't
the
make
correlation
any sense.
kind of broke.
Yeah, the bond market didn't protect in 2022 on the downside. So why are we doing 60-40? Now it's kind of been back, but now they're putting a little bit of a different spin on it, maybe 60-30-10, which sounds reasonable to me. And that's kind of like our endowment series. And now that's why we're introducing these other portfolios that kind of take advantage of that.
Right. So the most important question in the end now, like if our listeners hear that, clients, who wanted to invest with us, or advisors who wanted to work with us and wanted to have that that product or that offering for their clients, which again, we are one of the first ones in the US who are able to offer this for advisors. How can they work with us, Keith? How do they reach out to us?
So obviously they can get a hold of any of our marketers, consultants here at Gradient Investments, and happy to onboard any new advisors, and then clients too. If you're listening to this, and just reach out to your advisors that, if you're listening to us, you probably have a relationship with an advisor that probably works with us already. So those are the two places to start. But again, you can go to our website and you can get all that contact information if you're unaware of us. And it's a great resource. We're always looking to innovate and kind of structured notes. I would akin this back to that was, I think, about 5-6 years ago, Lisa, we released these, and kind of very unheard of. And now they're fantastic. And some people are putting in, 10, 15%. Again, every client's different about their allocation to it. Very powerful tool, been very successful. They allow you to participate to an upside cap, but also give you some buffer or downside protection, which again, most of our advisors and our clientele, their clientele are kind of pre-retirement or retirement. So they want that some level of safety because their income at some point in time is going away. And same with these other assets we're, rolling out.
But same with the structured notes. We were one of the first ones to the market with these.
Now they're out and they're pretty popular now.
Right. But again, it's like we're again one of the first movers here, which kind of shows how innovative we are. And
for sure.
How we want our advisors to have these offerings for their clients, whatever they need, and that clients can choose whatever fits their plan and their financial journey. So that's great. You can also see our website and our email address in the description box below. So reach out to us. We're happy to help. And I thought, like, to end today's episode, we end a little on a fun note here. Fun.
I don't know if it's fun.
I don't. Yeah. That was probably the wrong description to that, because it's getting really uncomfortable in Minnesota on this weekend. And when I kind of pulled up the weather app, it said we can have like a maximum, minimum, whatever you want to say, of minus 25 degrees.
Minus 25. Fahrenheit. What is that?
That doesn't even include the wind.
That doesn't even include the wind. And usually I'm still not really acquainted to Fahrenheit versus Celsius because I grew up in a Celsius world. But with minus 25, I know I can spare myself the conversion
because
I know
close.
it's first of all, it's real close.
Is it really?
Because
I think they convert it like minus 40.
They convert, so it gets really close, and I know it's miserable, so there's no need to convert anymore. So what I want to know from you, and this weekend it gets really Minnesotan wintry here. So what I want to know from two original Minnesotans, what are you doing? Are you still out and about and saying, hey, there's no cold bad weather, it's just bad,
just bad attitudes,
clothes, so bad attitudes, just no excuses, get out and do something? Or are you at this point just sitting it out? Like, what is too cold for Minnesotans?
Well, I have a feeling if you have kids, it probably makes a difference, like young kids, versus you. I would imagine the contrast is little. You've paid you've done your jail sentence. So for us, we have our kids doing cross country, so Nordic skiing, and also alpine, like downhill
even
skiing.
With minus 25.
Yeah, so they will
moving.
They will cancel downhill skiing if it's minus 30, I think.
That's not even. But
people are there. So we had this bout of, I think it was minus 15 right before Christmas, and we were out. We were doing it, and the Yeti did not keep the coffee warm. Did not work.
But the Minnesotans persevered.
We were out and about. So do I like doing that? No, I like being at home and starting a fire in the fireplace.
Okay, but you're.
But we do go out. Yeah.
That's the kids.
That's where
Keith, what you're saying. I mean, your kids are out of the house.
Yeah,
are
they're college
changing
age.
it a little bit
now? Kyle nailed that one. It's
less obligation and guilt.
With little kids, there's too much energy to be in the house. You got to go out and do stuff. So mine are older, so they're fine. So it is definitely build we have a wood burning fireplace, so
Mhm.
that'll be used quite heavily. I do get outside, at least once or twice a day to walk the dog, and
Yeah.
I do bear that. But
Now, does the dog in -25 have the booties
he
that
does
go
get
on?
the boots.
Oh, yeah, ours
So,
ours
it's
have to
rock
get the boots too,
solid.
because otherwise it's like they do the paw thing.
He sounds like you put him on, then he sounds like a horse going around the hardwood
So he's
floors.
probably not enjoying it either.
Oh,
Yeah.
he's a
Outside.
Bernese mountain dog,
Mhm.
with a poodle mix. So he's kind of mountain dog. It's kind of he actually enjoys the cold weather, which
Mhm.
so he'll stay outside longer than
You put the
I would.
barrel on there.
No, I should for myself.
Yeah, for yourself.
How about you? What do you do?
I'm fleeing to San Diego, California this weekend.
Oh, are you? Good for you.
Perfect timing.
Good for
Mr.
you.
D
Like,
staying and you're leaving.
Yes, perfect timing. Unfortunately, it's still cold when I'm coming back,
Mhm.
so I
Oh,
probably
you missed a
should-
couple days of it.
Yes, so I'm still in it for a couple of days, I think, when I'm coming back. But I have it planned for a longer time, so now it's kind of coincidence that it's exactly this weekend when it
Mhm.
gets really cold. But other than that, I'm basically sitting it out as well.
Yeah.
I'm not going out all that much
Mhm.
anymore when it's getting that cold.
Throwing the cat on your feet or something like that to keep him warm.
Well,
Mhm.
which is interesting because you said you have a Bernese mountain dog,
Yeah.
which is built for the cold temperature.
Mhm.
I have a Norwegian forest cat. And the name suggests, Norwegian forest cat.
Yeah.
That cat is built for
It was.
It's
Norway's
durable.
winters.
It's
It's
ready.
durable. It's built for the outside. When I open the balcony door, the cat says, absolutely not.
Mhm.
I'm going
So,
back.
right. So that thing would not survive 5 minutes outside. So
Mhm.
there's to that. But yeah, basically sitting it out as well. So
Mhm.
I'm not as Minnesotan, unfortunately. Anyways, for all of our listeners, stay warm. If you're somewhere else, in the
Yeah, if you're not
US.
in Minnesota,
If
hopefully
you're not
you
in
are.
Minnesota, and there's a snowstorm coming even for the
Mhm.
East Coast this weekend.
there
So
is?
yeah,
Oh, yeah.
yep.
It's cold
So-
everywhere.
It's cold everywhere.
All right.
Okay, stay
Stay
warm,
warm.
and yeah, we are back next week with another actually exciting announcement that
that'll be a good
we
one. Nice
that we
tease.
didn't
I
get
like it.
to today.
Yeah.
So stay tuned and make sure you're back for next week.